Every trader knows how important a market structure break is. But the problem is that people are not able to identify significant highs and separate the significant highs and lows from the insignificant highs and lows. And also there's a second problem. And that's that people do not know when a market structure break is actually being confirmed, which means that they can execute a trade. Both problems will be explained in today's video, and both of them will make sure that once you understand, you are already ahead of 99% of people that do not see these two problems. So without further ado, let's dive into it. So now when we speak about market structure breaks, what a lot of people think is that, let's say this high that I mark out right over here is our high that we want to break. A lot of people tend to think that as soon as a candle closes above that high, or some people even think if price only wicks above that high to break, that in that case our market structure break is confirmed and they start longing the price with their stop beneath this low, targeting reversal and higher levels. This is the way that the majority of people trade and identify market structure breaks, either by price wicking above a high or below a low, or price closing a candle above a high or below a low. This is not the way you should identify market structure breaks. We should always wait for a candle to not just close above this high, but to open above that high and close above that high as well. So in this instance, we can see price closes above this high right here. Market structure break not confirmed yet. The next candle closes below again. Once again, market structure break not confirmed yet because we open above it, but we close beneath it. We need to open and close above this high to confirm the market structure break. If we play the chart, we can see that every single time those candles, they do not open and close above this high right over here. We close above it multiple times, we wick above it multiple times, but we do not open and close any candle above this high to break at any time, which means that the market structure break is not confirmed. And a lot of people got trapped into trading the reversal right there with their stop beneath that low, targeting higher levels. And we can see that all those people that longed because they didn't know how to identify a proper market structure break, they got stopped out and price started pushing a lot lower. So the most important takeaway so far is that you always have to wait for a candle to open and close below a significant low or above a significant high. Not close above, not open above. We need a candle to open and close above a significant high or below a significant low. But now we run into problem number 2, which is the difference between significant highs and insignificant highs and significant lows and insignificant lows. I'm going to explain that to you guys on the whiteboard. Let's go. Let me draw out 2 charts for you. One on the left and one on the right. We have a high on the left and we have a high on the right. The one on the left is the one we want to trade, and the one on the right is the one we do not want to trade. Now, what is the difference between these two? Because the one on the left is a significant high and the one on the right is an insignificant high. The difference is that the one on the left, this one, brings us towards a lower low in price compared to this low that brought us towards that high in price, which means lots of sellers stepped in over here and they pushed the price lower, which means that this high then carries significance. This high, on the other hand, only brings us towards a higher low in price compared to this low that brought us towards that high. Therefore, not enough sellers stepped in over here, and therefore this doesn't carry any significance at all. And that's the difference between a significant high and an insignificant high. Now, obviously, it works the other way around as well, guys. The other way around, it works the exact same. Because what we can see is that on the left, we can see a significant low, and on the right, we can see price breaking through an insignificant low. Once again, the exact same concept applies. It only brings us towards a lower high, and this one brings us towards a higher high. So this is what we call a significant low to break. And this is where we want to open and close candles below this low in order to confirm the market structure break. So now you understand the difference between a significant high and an insignificant high. And you also know that we always have to wait for a candle to open and close above a significant high or below a significant low. But what you haven't seen yet is a real-time example of all of the information that I've shared with you guys so far being put to the test. So, as always, let me also give you guys a real-time trade example. So what we can see on the chart over here is that Bitcoin was in a major uptrend. In this case, I'm using Bitcoin, but obviously we can use any asset for this matter. We can see a massive uptrend on a 4-hourly time frame. We can also see that at the same time, Bitcoin was potentially deviating above this range high. Now, in order to anticipate shorts and actually execute shorts, we then need a bearish confirmed market structure break. So first we need to identify our significant low to break. And we can see that if I play the chart a little bit, that this was the low right over here. That is bringing us towards a higher high over here compared to this high that brought us towards this low. So this right now is our significant low to break because it's a low that brings us towards a higher high in price and not towards a lower high in price. Then we can see if I continue to play the chart eventually, we start pushing beneath that low after confirming the deviation above the range high. So deviation has been confirmed. This is our low to break on a 4-hourly time frame, which means that we want to wait for a 4-hour candle to open and close below the low. Not just wick below the low, not just close below the low, like this red candle over here. No, open and close below the low, which happened at this green candle right there. This green candle opened below the significant low to break and also closed slightly below the significant low to break. That was our short trigger where we could start executing shorts on Bitcoin with our stop above the high right here, because that's the high that brings us towards this lower low in price. And then we can target the range low. So we have our range high, we have our range low. We need to market such a break to confirm our trigger so that we can start executing shorts. This is in that case what that short looks like, based on that market structure break as our trigger after identifying the correct structure. And we can see that eventually this, obviously, as you guys know, turned out to be a beautiful trade because Bitcoin started slowly pushing towards new yearly lows. So now you know the difference between a significant high and low to break and an insignificant high and low to break. Now you also know that we need to wait for a candle to open and close below a significant low and above a significant high. A wick isn't enough, a candle close isn't enough. And I've also shown you guys a real-time example of how this was put to the test. This is so important to be aware of. And it's just as important as knowing that indicators do not matter at all. And that is exactly what my previous educational video was about. I will leave a link to that educational video in the description down below, or you can check out that educational video on indicators right over here or maybe right over here. I want to thank you guys for tuning in, subscribe to the channel, catch you guys on the next one. Ciao, ciao!